Now, picture this. Noah is 47, living in Austin, Texas. He earns $95,000 a year. On paper, he's doing everything right. He maxes out his 401k contributions, packs lunch every day, skipped a few vacations to boost his savings. Personal finance accounts would call him disciplined, a hero. But here's the thing. Discipline alone is not enough. Noah checks his retirement dashboard one evening and notices a problem. Despite his efforts, his projected retirement balance is far below what he expected. Something doesn't add up. You might be thinking, just save more. That's what Noah did for years. But the real issue isn't saving less. It's where his money is and how it's working for him. Think of retirement like a rocket launch. Early in the process, every dollar you save is like fuel. Each contribution matters immensely. But at some point, your rocket is already in orbit. Extra fuel added to the launch pad won't help. It's wasted effort. That's exactly what happens to Noah. He's still running back to the launch pad while his portfolio, the rocket, is already in space. Noah's three levers are savings, return, and time. In his 20s and 30s, time is a superpower. In his 40s and 50s, return efficiency becomes far more important than adding another dollar to savings. He didn't realize it, so he kept doubling down on the least effective lever. Now, here's the eye-opening part. If you're like Noah, this could cost you tens of thousands, maybe more, by retirement. And the worst part? Most people cross this financial threshold without even noticing it. There's no alarm, no notification, just the quiet loss of potential wealth. Look, here's the truth. Noah's story is not unique. Most Americans in their 40s and 50s are still following the same save more advice from the early 2000s. And that's why we're here today, to break the pattern. Be honest, if you've been doing this, comment 1. Next, we'll dive into Noah's three levers, how they work, and how to know when it's time to stop adding fuel and start optimizing the rocket itself. Now, let's break it down. Noah has three levers for building retirement wealth: savings, return, and time. Understanding them is the key to knowing what actually moves the needle. First, savings. This is the money you actively put away. It's tangible. You can control it. Noah has been doing this his entire adult life, maxing out his 401k, packing lunch, skipping vacations. And early in life, this lever is incredibly powerful. Here's why. Imagine you invest $10,000 at age 25. At a 7% annual return, by age 65, that $10,000 alone grows to roughly $150,000. That's without adding another dollar. Just $10,000 invested early. Time multiplies the effect. Now, fast forward to Noah at 47. That same $10,000 invested today grows to about $39,000 by retirement. Same return rate, same math, different starting point. Time isn't on his side anymore. The early advantage of compounding has largely passed. Next lever, return. This is how efficiently your money grows. Fees, fund choices, and allocation directly affect this. Noah didn't pay attention here. He kept money in high-fee, actively managed funds. Each year, a portion of his gains was quietly siphoned off by fees. Let's make it simple. If you earn 7% on a $200,000 portfolio, but pay 1% in fees, you're losing $2,000 in potential growth in the first year alone. Multiply that across decades, and the cost compounds faster than the extra dollars he added to savings. Finally, time. This lever is straightforward in youth, complicated later. Time is the multiplier for everything. The longer your money grows, the greater the compounding. Early contributions produce exponential impact. Later contributions matter less in isolation, but can still support smart strategies. Here's the twist. The power of each lever changes with age. When Noah was in his 20s and 30s, adding more savings was the highest leverage move. Now, at 47, optimizing return efficiency is far more important. Shifting to low-cost funds, rebalancing allocations, and using tax strategies can add more to his retirement balance than a decade of extra saving. This is the crossover point, the moment when your existing portfolio matters more than every extra dollar you can contribute. Most people like Noah never see it coming. They continue doubling down on savings because it's visible and feels productive. But it's actually the least efficient lever at this stage. Think of it like a rocket. Early in the launch, every pound of fuel counts. Later, once the rocket is in orbit, extra fuel on the launch pad does nothing. What matters is pointing the engines in the right direction and reducing drag. Noah has been obsessing over fuel while ignoring navigation. Understanding these three levers is not theoretical, it's practical. When you know your crossover point, you know which lever deserves your attention. More importantly, you realize that effort does not equal impact in finance. Saving more is not always the path to greater wealth. Sometimes, doing less but smarter produces bigger results. And here's a small secret. This insight is rarely taught. Why? Because the advice industry profits when people keep contributing to the savings lever without understanding the bigger picture. Knowledge of these levers gives you leverage that most advisors don't emphasize. Next, we'll explore Noah's crossover point and the psychological traps that make even disciplined people like him double down on the wrong lever. Here's the part most people miss. Noah is disciplined, smart, and consistent. Yet he's still leaving hundreds of thousands of dollars on the table. Why? It's called the crossover point. There's a specific portfolio size where the return lever overtakes the savings lever in importance. Beyond this point, adding extra dollars to savings grows your wealth less effectively than improving returns. Let's make it simple. Imagine Noah contributes $12,000 a year and has $200,000 already invested. If he adds $5,000 more per year, that extra saving generates around $125,000 over 15 years at a 7% return. Real money, yes, but not huge. Now consider return optimization. If he shifts his existing $200,000 into low-cost index funds, rebalances allocations, and reduces fees, his effective net return might go from 6.1% to 7.5%. Over the same 15 years, this could add over $100,000 to his portfolio, without contributing a single extra dollar. This is the exact point where most people make a psychological mistake. They equate effort with results. The more they sacrifice, skip vacations, cut spending, push savings, they feel in control. It's called effort-reward coupling. Effort-reward coupling is a deeply wired human tendency. In school or work, effort usually equals progress. But investing is counterintuitive. The highest leverage actions often require the least visible effort. Checking and optimizing your portfolio, auditing fees, and adjusting allocation might take 45 minutes. It doesn't feel like sacrifice, yet it can outperform years of scrimping and extra contributions. Noah's mistake is rational in his mind. He sees a larger contribution number on his quarterly statement and feels progress. It's satisfying. But in reality, he's applying the right tool at the wrong phase. Savings were the hero in his 20s and 30s. Now, in his late 40s, return optimization is the high-leverage move. This crossover is not vague. It's calculable. A good rule of thumb: if your investable portfolio is roughly 10 to 12 times your annual retirement contributions, you've likely crossed it. Beyond this, the return lever dominates. Most Americans in their mid-40s are already past it, yet still obsess over savings because it's tangible and visible. There's another trap: fees. Active funds with expense ratios of 1% quietly siphon off gains. At this stage, each percentage of return matters far more. A small adjustment, switching to low-cost funds or rebalancing allocation, can have a bigger impact than months of lifestyle sacrifice. And it doesn't stop there. Taxes also play a role. Roth conversions during lower income years can produce guaranteed, long-term returns that dwarf extra savings. Yet most people never consider this window. Understanding the crossover point and its psychological traps is the game changer. Once Noah knows this, his perspective shifts. He stops running back to the launch pad and starts steering the rocket. In the next section, we'll explore fees, fund choices, and how to maximize return efficiency, showing exactly how Noah can reclaim lost wealth without adding another dollar to savings. Now, let's talk about fees. This is where most people like Noah leave money on the table without realizing it. Many retirement accounts are filled with actively managed funds. They promise expertise, but the reality is expensive. The average expense ratio in the US for active funds is about 0.66% per year. That doesn't sound like much, right? But on a portfolio of $200,000, that's over $1,300 lost in the first year alone, and it compounds quietly every year. Compare that to low-cost index funds, which charge roughly 0.06% per year. The difference might seem small, but over a 15-year horizon, switching can save hundreds of thousands. And here's the kicker. This requires almost no ongoing effort. A 45-minute portfolio review can outperform years of extra contributions. Noah never realized this. He was maxing his savings and cutting expenses, yet his funds were quietly draining potential wealth. Let's do a simple illustration. Noah has $200,000 in a fund charging 1% fees. Over 15 years at a 7% gross return, his effective return drops to 6%. That's a difference of roughly $120,000 compared to a low-cost alternative. That's money lost without doing a single extra push on savings. Fees aren't the only issue. Allocation matters too. Noah's portfolio had a mix that was too conservative for his timeline. Target date funds often shift to conservative allocations 25 years before the target date. That's too early for a 47-year-old with a 15-year horizon. Equity exposure was reduced prematurely, limiting growth potential. By reallocating to a more aggressive, yet still diversified index fund structure, Noah can increase his expected annualized return by roughly 0.5 to 1%. It may seem modest, but over 15 years, it translates into tens of thousands of extra dollars in compounding gains. The principle is simple. After the crossover point, optimizing returns through fees and allocation is the highest leverage move. Extra contributions are still good, but the efficiency of existing assets matters more. Here's another insight. This is not a complicated strategy. Anyone can log in, check fund fees, compare to low-cost alternatives, and adjust allocations slightly. It costs nothing extra. It doesn't require cutting coffee or skipping vacations. Yet most people ignore it. Why? Because visible effort, like saving more, is satisfying. It feels like control. Return optimization, fees, and allocation are invisible until you calculate them. This is where Noah's rocket analogy comes alive. The launch pad is behind him. His savings habit is fuel he's already delivered. The rocket, his portfolio, is in orbit. What matters now is pointing the engines correctly and reducing drag. Fees are drag. Poor allocation is misaligned engines. Fixing these can add wealth faster than grinding out extra savings. Up next, we'll explore tax efficiency and Roth conversions. This is the next high-leverage lever Noah can use to secure tax-free growth and maximize retirement wealth. Again, without adding a single extra dollar to contributions. Now that Noah understands fees and allocation, it's time for another powerful lever: tax efficiency. Most people don't realize taxes can silently erode decades of growth. Traditional 401ks and IRAs grow tax-deferred, but withdrawals are taxed at ordinary income rates. That's fine if your strategy is simple, but a smarter approach exists: Roth conversions. Here's how it works. Suppose Noah has $50,000 in a traditional 401k. In a year where his effective federal rate is 22%, he converts it to a Roth account. He pays $11,000 in taxes now. It stings, but consider this. Over 15 years, that $50,000 could grow to $200,000 inside a Roth. That's $200,000 of gains completely tax-free. Compare that to leaving the money in the traditional account. When Noah withdraws it later, he could owe $36,000 in taxes on the same growth. By paying $11,000 now, he effectively gains a 30% guaranteed return. That's a rare, risk-free opportunity. Timing is everything. Roth conversions are most effective when income dips temporarily or between jobs, or if you're in a lower tax bracket than you expect in retirement. Miss the window and the opportunity is gone. Another simple tip. Think about asset location. Bonds produce ordinary income, taxed at higher rates. Equities generate long-term capital gains and qualified dividends, taxed lower. Moving bonds into tax-advantaged accounts and equities into taxable accounts reduces ongoing tax drag. It's pure efficiency. It doesn't require increasing contributions or cutting spending. One afternoon of paperwork can add tens of thousands over time. The lesson is clear. At Noah's stage, return optimization now includes tax efficiency. Fees, allocation, and taxes together determine how fast wealth grows. Extra contributions matter less than improving the efficiency of what's already invested. Most financial books don't talk about this. Advisors may underemphasize it because it doesn't generate fees or new assets under management. But for Noah, it's a high-leverage move. It's invisible, it's underutilized, and it can dramatically increase retirement wealth without lifestyle sacrifice. Next, we'll explore portfolio allocation and risk management. Noah will learn how to balance growth and protection, ensuring his optimized returns are also safe and sustainable. Once Noah has optimized fees and tax efficiency, the next lever is portfolio allocation and risk management. Many people confuse high returns with smart investing. That's not the case. Returns only matter when they're risk-adjusted. A concentrated bet might soar one year, but it can crash the next. Noah learned this the hard way. Take the example of putting 70% of your portfolio into a single real estate investment trust. It might look good initially, but a sharp downturn can wipe out years of growth. Diversification spreads risk, ensuring that one bad investment doesn't destroy the whole portfolio. Noah shifted to a diversified index fund strategy. Broad U.S. market, international stocks, and bonds in a mix appropriate for his 15-year horizon. Not too aggressive, not too conservative. This way, returns are more predictable, and compounding works without disruption. Equity allocation is critical. Target date funds often reduce stock exposure too early. For Noah, a 47-year-old with 15 years to retirement, a higher equity allocation is optimal. It provides growth potential while still managing risk through diversification. Risk management is also about sequence of returns. Early losses near retirement can be devastating. Noah avoided this by maintaining a balanced allocation and avoiding concentrated bets. The goal is to maximize return within a safe, diversified framework. Small adjustments can yield big results. For example, moving from a blended 60-40 allocation to a slightly more aggressive 70-30 can increase annualized return by 0.5% to 1%. It seems small, but over 15 years, it compounds into tens of thousands. The key takeaway: optimizing allocation and managing risk works hand in hand with fees and tax efficiency. Together, they form the most powerful levers for wealth in your late 40s and 50s. Noah now understands. Saving more is not always the highest leverage action. Smart adjustments to allocation, fees, and taxes can grow wealth faster than decades of extra contributions. In the next section, we'll cover Social Security and late-stage moves, showing Noah how strategic timing can add guaranteed, inflation-adjusted income during retirement. Now, Noah looks at Social Security. Many people treat it as an automatic background benefit. They claim it as soon as possible. That's a mistake. Timing Social Security can add guaranteed, inflation-adjusted income over decades. For example, delaying claims past age 62 increases monthly benefits roughly 5 to 8% per year, depending on birth year. The window between 66 and 70 offers the maximum 8% annual increase. Noah models his retirement. If he waits until 70 to claim, his monthly benefit rises significantly. Combined with his optimized portfolio, this delay adds tens of thousands in lifetime income without contributing another dollar. It's a safe, government-backed return. Unlike stock markets, Social Security is predictable. Many miss this opportunity because it requires reading the rules and running a simple analysis using the SSA's free tools. This is another example of a high-leverage move that feels invisible. Noah doesn't have to work harder or save more. He simply plans strategically, ensuring guaranteed growth in retirement income. At this stage, Noah's strategy is clear. Focus on return optimization, allocation, fees, tax efficiency, and Social Security timing. These levers are far more effective than running back to the launchpad and adding more fuel in the form of extra savings. Next, we'll summarize all key takeaways and actionable steps, giving Noah and you a concise plan to maximize retirement wealth efficiently.